Hi there, it's Friday the 21st of September 2018. I'm Steve Towers. Welcome to International Tax Bites, ITB, my weekly review of the important international tax developments impacting multinationals. This week I have these stories for you. Last Friday, the OECD released all of the public comments it has received in regard to its July non-consensus discussion draft on the transfer pricing aspects of financial transactions. And there's a lot of public comments from 71 organisations in 965 pages. If you would like to read them all, or perhaps to reread the discussion draft, please go to our website or app. Alternatively, sit back and listen to me. I'll give you the highlights. The most controversial topic in the discussion draft is the application of the arm's length principle to a company's capital structure. For example, to treat debt as equity. The discussion draft says this: it may be the case that the capital structure of a borrowing entity that is part of an MNE group differs from that which would exist if it were an independent entity operating under the same or similar circumstances. This situation may affect the amount of interest payable by the borrowing entity and so may affect the profits accruing in a given jurisdiction. The discussion draft then notes that such an analysis can be under either of the two stages which are identified in the transfer pricing guidelines. This guidance elaborates on how the concepts of Chapter 1 of the TPG, in particular the accurate delineation of the actual transaction under Section D.1 of that chapter, may relate to the capital structure of an entity within an MNE group. That's the first stage, where it is considered that the arrangements made in relation to the transaction, viewed in their totality, differ from those which would have been adopted by independent enterprises behaving in a commercially rational manner in comparable circumstances. The guidance in Section D.2 of Chapter 1 may also be relevant. That's the second stage. Interestingly, although there are many references to accurate delineation in the rest of the discussion draft, there's no further express reference to the second stage. That point was picked up by PwC, who said this: we also recommend the distinction between accurate delineation and re-characterisation is included within the revised DD. There is extensive reference to the phrase accurate delineation within the DD, and this should not be used as a tool by tax authorities to re-characterise a transaction unless the specific thresholds within Section D.2 of Chapter 1 of the TPG have been met. Many commentators express the view that this topic of capital structure should not be included in the discussion draft for a number of reasons, including that Article 9 does not cover it. For example, the Tax Executives Institute, TEI, said this: the recharacterisation of a financial instrument as debt or equity, either in whole or in part, is misplaced in the draft and should be removed or significantly modified. TEI also referred to reported comments of a US Treasury official in June this year that the position of US officials remains that Article 9 and the arm's length principle should focus on pricing rather than characterisation issues. And EY put it this way: we do not believe that the arm's length principle is so elastic. We question whether a multinational's capital structure can be evaluated by subjective considerations of what unrelated parties would do. In the discussion draft, the OECD raises the topic of the interaction of its Article 9 guidance on capital structure with domestic law rules on the same topic. It said this: although this guidance reflects an approach of accurate delineation of the actual transaction to determine the amount of debt to be priced, it is acknowledged that other approaches may be taken to address the issue of the capital structure under domestic legislation before pricing the interest on the debt so determined. These approaches may include a multi-factor analysis of the characteristics of the instrument. Accordingly, this guidance is not intended to prevent countries from implementing approaches to address capital structure and interest deductibility under domestic legislation, nor does it seek to mandate accurate delineation under Chapter 1 as the only approach for determining whether purported debt should be respected as debt. Although countries may have different views on the application of Article 9 to determine the capital structure of an entity within an MNE group, the purpose of this section is to provide guidance for those countries that use the accurate delineation under Chapter 1 to determine whether a purported loan should be regarded as a loan for tax purposes. BEAC made these comments: we believe the approach in regard to domestic legislation is counterproductive as currently drafted, as it undermines priority of OECD guidance by suggesting that if countries already have measures to restrict or recharacterise FT, financial transactions, that this OECD guidance may not be useful. It seems unusual for the OECD to resign itself to A, not being able to provide consensus guidance on FTs, or B, accepting that unilateral measures implemented domestically will trump the application of the arm's length principle to FTs. If the OECD would like to move forward with delineation guidance, it is our view that it should be taken as the primary guidance. If not viewed as the primary consensus guidance, we run the risk of proposing new rules without bringing in line existing regimes or providing a boundary of rules for unilateral actions. The discussion draft specifically asked for feedback on the capital structure example given in paragraph 17. Consider a situation in which Company B, a member of an MNE group, needs additional funding for its business activities. In this scenario, Company B receives an advance of funds from related Company C, which is denominated as a loan with a term of 10 years. Assume that, in light of all good faith financial projections of Company B for the next 10 years, it is clear that Company B would be unable to service a loan of such an amount. Based on these facts and circumstances, it can be concluded that an unrelated party would not be willing to provide such a loan to Company B. Accordingly, the accurately delineated amount of Company C's loan to Company B for transfer pricing purposes would be a function of the maximum amount that an unrelated lender would have been prepared to advance to Company B. and the maximum amount that an unrelated borrower in comparable circumstances would have been willing to borrow from Company C. Consequently, the remainder of Company C's advance to Company B would not be recognised as a loan for the purposes of determining the amount of interest which Company B would have paid at arm's length. The specific question which the OECD asked in the discussion draft was whether, in this situation, the whole of the amount of funding should be treated as equity, or merely that portion which was considered to be excessive. Everyone seems to agree that it should just be the excessive amount. But there were many other comments made on this example. Firstly, there was a focus on the phrase, Company B would be unable to service a loan of such an amount. For example, EY said this, loans are not required to be fully paid off from current operations in order to be considered valid. Unrelated parties commonly incur debt that they expect to service and refinance over time with no intention of ever decreasing their leverage. For example, the business may be a strategic investment that is expected to pay off over a much longer term than 10 years, with the loan expected to be refinanced in the future. We suggest that the OECD clarify that planning to refinance the debt in a future period should be considered as a possible factor when delineating the transaction. Secondly, there's a concern about the subjectivity of this test. TEI said, the maximum amount that an unrelated lender would have been prepared to advance to Company B can be vague. Should tax authorities consider the possibility of posting collateral, implicit support by the group, the strategy of the group, or the reputational damage to Company B? And EY said, the suggested test with regard to the maximum amount that an unrelated borrower in comparable circumstances would have been willing to borrow is also a subjective one, as two companies with identical operations under the same facts and circumstances may adopt two completely different capital structures. Selection of the appropriate capital structure is part of the company's management decision-making process, which depends on many quantitative and qualitative factors, including the risk appetite of the company itself and its shareholders, the management's long-run strategic plan, the manner in which the management intends to grow the company, etc. And thirdly, some concern was expressed as to the consequences of the deemed change in capital structure. For example, BEAC asked for confirmation as to whether the interest payments on recharacterised debt would themselves be recharacterised as dividends for withholding tax purposes. In regard to the topic of risk-free rate of return, the discussion draft starts by stating this principle, where, in accordance with the guidance in Chapter 1 of the TPG, the accurate delineation of the actual transaction shows that a funder lacks the capability or does not perform the decision-making functions to control the risk associated with investing in a financial asset, it will be entitled to no more than a risk-free return as an appropriate measure of the profits it is entitled to retain. Several commentators disagreed with the principle. For example, KPMG and TEI criticised the automatic application of this principle. The discussion draft then considers how to determine the risk-free rate of return. It specifically asks for realistic alternatives to government-issued securities to approximate a risk-free rate of return. Commentators suggested LIBOR, SOFR, the secured overnight financing rate, interest rate swaps, and instruments issued by sovereign wealth funds. Several commentators pointed out that the issue of negative interest rates on government-issued securities, for example Germany, and other instruments should be addressed. The discussion draft then specifically asks for comments on the practical implementation of paragraph 11 of box B.4, which says this: where a funder lacks the capability to control the risk associated with investing in a financial asset, and so is entitled to no more than a risk-free rate of return, subject to other constraints, the funded party would still be entitled to a deduction up to an arm's length amount in respect of the funding. The difference between those amounts would be allocable to the party exercising control over the investment risk in accordance with the guidance in Chapter 1. Let's look at an example of how this should work. Funder has made a loan at an arm's length interest rate, let's say 6% per annum, to funded party. Funder is a cash box. It has no capability to make decisions to control the financing risk. Therefore, according to the discussion draft, funder is entitled to no more than the risk-free rate of return. Let's assume that that is 1% per annum. The difference between the two numbers, 5% per annum, is allocated to Exco, the related party which does exercise control over the financing risk for this loan. Although the discussion draft does not say this, the transfer pricing guidelines would indicate that that 5% per annum is a notional fee paid by funder to Exco, not interest paid by funded party directly to Exco. The discussion draft does say that funded party, the borrower, is entitled to a deduction for the full 6%, assuming the other requirements of the Country B tax law have been satisfied. Deloitte UK called for an expansion of paragraph 11. Without significant expansion of the draft guidance within paragraph 11, disputes between businesses and tax authorities and between tax authorities are likely, with the potential for double taxation. In particular, more clarity is needed to address A, how to determine whether a funder lacks capability to control the risk associated with investing in a financial asset to such an extent that the residual return over the risk-free return is reallocable. Consideration should be given as to differences in the level of functions expected from a company entering into a one-off transaction and a fully operational treasury company which enters into financial transactions on a daily basis. B, how to determine precisely which related party or parties exercise control over the investment risk in accordance with the guidance in Chapter 1. And C, how to numerically divide the residual return between the relevant parties. And Deloitte also made the point that there might not be only 3 parties involved. It's possible that there could be several related companies in the possession of Exco, particularly if there's both global and regional management, which then raises the question of whether such complex situations can be dealt with through the MAP process, which a number of commentators mentioned. This particular topic concerns a single paragraph in the discussion draft, paragraph 140, which says this: where the effect of a guarantee is to permit a borrower to borrow a greater amount of debt than it could in the absence of the guarantee. The guarantee is not simply supporting the credit rating of the borrower, but could be acting both to increase the borrowing capacity and to reduce the interest rate on any existing borrowing capacity of the borrower. In such a situation, there may be two issues: whether a portion of the loan from the lender to the borrower is accurately delineated as a loan from the lender to the guarantor, followed by an equity contribution from the guarantor to the borrower, and whether the guarantee fee paid with respect to the portion of the loan that is respected as a loan from the lender to the borrower is arm's length. The conclusion of an analysis of such transactions may be, taking into account the full facts and circumstances, that the evaluation of the guarantee fee should be limited to a fee on the portion of the alternative structure appropriately characterised as debt, and the remainder of the loan granted should be regarded as effectively a loan to the guarantor, followed by an equity contribution by the guarantor to the borrower. A picture is worth 1,000 words, or in the case of the OECD, 10,000 words. In the diagram on the left are the transactions as documented by the parties. Unrelated lender lends X dollars to borrower. Borrower's loan of X dollars is guaranteed by a related party guarantor. Borrower pays a guarantee fee to guarantor. The diagram on the right shows the accurately delineated actual transaction. Unrelated lender lends Y dollars to borrower. Borrower's loan of Y dollars is guaranteed by related party guarantor. Borrower pays a guarantee fee to guarantor. Lender lends Z dollars to guarantor, and guarantor makes an equity injection of Z dollars into borrower. And as shown at the bottom, X equals Y plus Z. And let me comment that the phrase accurately delineated actual transaction is not an accurate description of what's going on here. This is not accurate delineation. It's a re-characterisation under section D.2 of chapter 1. Most commentators don't like paragraph 140, particularly the fact that it involves a loan from an unrelated lender. Some, for example BEAC and TEI, call for its deletion. Others, for example KPMG and PwC, say that it should be applied only in limited circumstances. And finally, the financial sector. A number of commentators said that the discussion draft should either specifically identify how the new guidance should apply to businesses in the regulated financial sector, such as banks, or alternatively, it should exclude such businesses from the new guidance, on the basis that they are regulated and there is existing substantive guidance in regard to the attribution of profits to PEs in that sector. Well, Luxembourg and McDonald's have won. The European Commission has concluded that Luxembourg's tax rulings to McDonald's do not constitute illegal state aid. Here's a quick reminder of the structure. A Luxembourg resident company within the McDonald's group, Luxco, has a branch in the US. Franchise rights were acquired by Luxco and allocated to the US branch. Franchisees throughout Europe paid royalties to the US branch. According to the Commission, this structure was designed to achieve double non-taxation of the US branch's profits. No US tax and no Luxembourg tax. Luxco obtained 2 tax rulings from the Luxembourg tax authorities which said that there was no Luxembourg tax on the US branch's profits. It's those 2 tax rulings which were the focus of the state aid investigation. The Commission has now concluded that the structure did achieve its objective, double non-taxation, but it did so without breaching the EU state aid rules, and that's because the rulings were correct. The Commission's press release says this: the role of EU state aid control is to ensure that member states do not give selected companies a better treatment than others through tax rulings or otherwise. In this context, the Commission's in-depth investigation assessed whether the Luxembourg authorities selectively derogated from the provisions of their national tax law and the Luxembourg-US Double Taxation Treaty and gave McDonald's an advantage not available to other companies subject to the same tax rules. The Commission concluded that this was not the case. In particular, it could not be established that the interpretation given by the second tax ruling to the Luxembourg-US Double Taxation Treaty was incorrect, although it resulted in double non-taxation of the royalties attributed to the US branch. Therefore, the Commission found that the Luxembourg authorities did not misapply the Luxembourg-US Double Taxation Treaty and that the tax advantage conferred to Luxco cannot be considered state aid. Luxco's US branch did not fulfill the relevant provisions under the US tax code to be considered a PE. At the same time, the Commission found that the Luxembourg authorities could exempt the US branch of Luxco from corporate taxation without violating the Double Taxation Treaty because the US branch could be considered a PE according to Luxembourg tax law. Under the relevant provision in the Luxembourg tax code, the business carried on by the US branch of Luxco fulfilled all of the conditions of a PE under Luxembourg tax law. Therefore, the Commission concluded that the Luxembourg authorities did not misapply the Luxembourg-US Double Taxation Treaty by exempting the income of the US branch from Luxembourg corporate taxation. Margaret Vestager is not happy with this result. She said this: the Commission investigated under EU state aid rules whether the double non-taxation of certain McDonald's profits was the result of Luxembourg misapplying its national law and the Luxembourg-US Double Taxation Treaty in favour of McDonald's. However, our in-depth investigation has shown that the reason for double non-taxation in this case is a mismatch between Luxembourg and US tax laws, and not a special treatment by Luxembourg. Therefore, Luxembourg did not break EU state aid rules. Of course, the fact remains that McDonald's did not pay any taxes on these profits, and this is not how it should be from a tax fairness point of view. That's why I very much welcome that the Luxembourg government is taking steps to address the issue that arose in this case and avoid such situations in the future. That last reference is to draft legislation, which is currently before the Luxembourg Parliament. According to the European Commission's press release, under the proposed new provision, the conditions to determine the existence of a PE under Luxembourg law would be strengthened. In addition, Luxembourg would be able to, under certain conditions, require companies that claim to have a taxable presence abroad to submit confirmation that they are indeed subject to taxation in the other country. For a copy of the Commission's press release, please go to our website or app. The Irish government has announced that it has finally collected the 14.3 billion euros from Apple, as required under the European Commission's state aid decision in 2016. The 14.3 billion euros consists of state aid, in other words tax, of 13.1 billion euros and 1.2 billion euros of interest. The money is now sitting in a third-party escrow account pending the outcome of the appeal process through the European courts. And in case there was any doubt, the Irish government reiterated that it profoundly disagrees with the Commission's analysis in the Apple state aid case. Oxfam has created a stir this week by releasing a report which shows that the profit margins of 4 major pharmaceutical companies are significantly higher in 4 identified hub countries, the report uses the term tax havens, than in the countries where the pharmaceutical products are sold. The report then draws the inference that this difference must be because of inappropriate tax planning. That in turn drew the ire of a senior tax official in the New Zealand government. John Nash was reported to have said this: "It's important to examine what multinationals actually do in a specific country such as New Zealand and how value is added before arriving at a conclusion that insufficient taxation has been paid. The New Zealand operations of pharmaceutical companies are almost entirely lower margin activities like distribution." If you would like to see the Oxfam report, you can find it at our website or app. And now for the developments in Asia Pacific. China's trade war with the US went from bad to worse this week. Let me do a quick recap of what's happened so far. Let me start in March this year, when the US Trade Representative issued the findings of an investigation into China's acts, policies and practices concerning transfers of US intellectual property. As a result of that report, the US government announced that it would target certain imports from China for additional ad valorem customs duty. The first round of shots were fired on the 6th of July. On that day, the US started to impose additional 25% customs duty on a list of 818 tariff lines, which comprise $34 billion of imports from China. On the same day, the 6th of July, China returned fire. Additional duties were imposed on 545 tariff lines, comprising $34 billion of imports from the US. The second round of shots were fired on the 23rd of August. The US imposed additional duties on a further 279 tariff lines, comprising $16 billion of imports from China. And China followed suit. Additional duties on a further 333 tariff lines, comprising $16 billion of imports from the US. Now we've come to the third round. The US has announced that additional duties will be imposed on 5,745 full or partial tariff lines, comprising $200 billion of imports from China. These US duties will be introduced on 2 dates. On the 24th of September, next Monday, additional customs duties of 10% will be imposed on those tariff lines. And on the 1st of January 2019, the customs duty rate will increase to 25%. China has responded, but in a more measured way. Effective the 24th of September, additional customs duties of 10% will be imposed on 3,571 tariff lines, and additional customs duties of 5% will be imposed on 1,636 tariff lines. Across the 2 groups, $60 billion of imports from the US are covered. Who knows where it will all end? Some folks have suggested that China might take the nuclear option, speaking metaphorically, of course, selling some of its $1.2 trillion of US government securities. But that would cause damage to both countries. China's not the only Asia-Pacific country to be increasing customs duties on imports. Indonesia announced an increase in its customs duty rate on more than 1,000 tariff lines, from 2.5% to 10%, effective from the 13th of September. And in New Zealand, the government's tax working group has released its interim report. At present, the group does not favour any reduction in the corporate income tax rate, but it is considering the taxation of capital gains on a broader basis. And interestingly, it does flag the possibility of New Zealand introducing a digital equalisation tax. For a copy of the interim report, please go to our website or app. And now for the developments in Europe. The European Court of Justice has decided a case, the EV case, in regard to Germany's participation exemption for dividends received from a subsidiary which is resident outside the EU. The conditions for the participation exemption in such a situation are stricter than those which apply to dividends received from a German subsidiary. The court determined that those stricter conditions could not be justified, and it therefore held that the difference in the conditions constituted a breach of the EU's free movement of capital. For a copy of this decision, please go to our website or app. In the Netherlands, the government has presented its Tax Plan 2019. Let me run through the changes which caught my eye. Firstly, there will be a gradual reduction in the corporate income tax rates. Currently, the rates are 20% for taxable income up to €200,000 and 25% for taxable income above that amount. The 20% rate will be reduced to 19% for 2019, then to 17.5% for 2020, and to 16% for 2021. The 25% rate will be reduced to 24.3% for 2019, 23.9% for 2020, and 22.25% for 2021. The carry-forward period for tax losses will be reduced from 9 years to 6 years. This will apply to tax losses incurred in the 2019 and later tax years. Under current law, there's a ring-fencing restriction for holding and financing losses. That will be abolished. The existing 15% dividend withholding tax will also be abolished with effect from the 1st of January 2020. but it will be replaced by a 23.9% withholding tax, which will apply to certain dividend payments. Dividend payments to low-tax jurisdictions, to non-cooperative jurisdictions, and dividends paid in certain abusive situations. As part of the Tax Plan 2019 package, the government has introduced a bill to implement ATAD 1. In regard to the earnings stripping rule, the bill reflects a number of important policy decisions. The deduction limitation on net interest expense is set at 30% of EBITDA. However, there is a threshold of €1 million. In other words, the first €1 million of net interest expense is deductible regardless of the 30% ratio. There will be an unlimited carry forward for excess interest expense, subject to a continuity rule. There will be no group ratio rule, and there is no exception for financial institutions or infrastructure projects, and there is no grandfathering rule for existing loans. In the UK, a parliamentary committee has released a report which calls for regulation of the cryptocurrency markets, which the report calls the Wild West. For a copy of the report, please go to our website or app. But of course, the big news in the UK at present is Brexit. Both the UK government and the European Commission have started to issue public information on the tax consequences of Brexit, which is scheduled to occur in March. In the latest of these communications, the UK government has sent letters to 145,000 businesses which trade only with EU countries, alerting them to the changes which will occur if there is a no-deal Brexit. And the European Commission has published a notice on the VAT consequences of Brexit. For a copy of these documents, please go to our website or app. And now for the developments in Africa. In Egypt, the tax authorities have released for public consultation draft transfer pricing guidelines, which are closely modelled on the 2017 OECD TPG. For a copy of the draft guidelines, please go to our website or app. And in Kenya, the dispute over the introduction of 16% VAT on petroleum products appears to have been resolved by an old-fashioned compromise. The VAT rate on these products will now be 8%. And now to the Middle East and Central Asia. In Armenia, the government has released two alternative proposals in regard to income tax rate changes. The first proposal deals only with individual income tax, but the second proposal contains changes to both individual income tax and corporate income tax. For corporate income tax, the rate would become 18%, down from the current 20%. And the withholding tax rate on dividends paid to non-residents would be 5%, as compared to the current 10%, subject to treaty limitations, of course. There's now a public consultation period. The changes are scheduled to apply from the 1st of January 2019. And now to the Americas. In Brazil, the government has outlined some tax reform proposals. Firstly, the corporate income tax rate, which is currently 34%, will be reduced to 21 or 22%. That rate level is driven by corporate rate reductions in OECD countries, particularly the US. Secondly, a tax will be imposed on dividend and profit distributions by Brazilian entities. There's no withholding tax under current law. And thirdly, the social contribution taxes will be simplified. Draft bills will be sent to Congress in October. In Canada, the tax authorities have lost another GAR case. This one is called Bank of Montreal. For a copy of the decision, please go to our website or app. In Peru, the government has issued Legislative Decree 1424, which makes a number of tax law amendments. Notably, the thin capitalisation rules will apply to both related and unrelated party debt. And earnings stripping rules based on BEPS Action 4 will be introduced, effective the 1st of January 2021. The deduction limit for net interest expense will be 30% of EBITDA. There are also changes in regard to indirect share transfers and the definition of permanent establishment. For a copy of Decree 1424, please go to our website or app. In the US, the proposed GILTI regulations released last week are receiving a lot of attention, particularly the two anti-abuse rules. The first of these rules concerns a US shareholder's pro rata share. This rule uses a principal purpose test. Any transaction or arrangement that is part of a plan, a principal purpose of which is the avoidance of federal income taxation, including but not limited to a transaction or arrangement to reduce a United States shareholder's pro rata share of QBAI and tested income, you will note that this refers to a principal purpose, not the principal purpose. The second of these rules concerns related party basis step-up transactions undertaken by non-calendar year taxpayers not yet subject to GILTI. This rule is a so-called per se rule. It's not based on purpose, but is instead automatic. I wonder if a similar rule will apply to FDII. And now for this week's treaty developments. We've had 3 treaties signed and 2 protocols enter into force. Well, that's the way it is this Friday, the 21st of September 2018. I'm Steve Towers. Have a great weekend.